Hello, very good morning to all, and I hope that you all have a great and restful weekend. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be a brand new week ahead, and today will be Monday, the 24th of June, 2024. So before we jump straight into our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into today's short-term intraday technical outlook on the various cross asset classes, let's have a quick recap what has taken shape on Friday, and most importantly, what has taken shape in early today's Asia session as well. So let us start with the release of the news flow first and economic data releases. So on Friday, we do have one key economic data releases that is out from the US economy. So on Friday, we do have this services PMI data that is out. Okay, let me do a quick check. Yeah, I hope that you guys could see everything and the screen is showing as well. Good. So over here, the S&P, the particular S&P make it compiler, they actually release preliminary PMI data across the globe from various region, ranging from Asia, Europe, and most importantly to US on last Friday. So for the US side of the story, market participants will be concentrating pretty much primarily on the services PMI. Why? Because we know that close to 3/4 of US growth is driven by services activity. So over here, the preliminary services PMI compiled by S&P, this is the flash data for the month of June, actually went above expectation at from 55.5 above 53.7. So if I were to open up this particular movement over here, okay, so it actually jumped way higher than what market expecting, and also it was actually the highest level if I were to go in a 5-year trajectory. So 55.1, so it was the highest level since April 2022. All right, close to around something like a two-year plus higher. So what does it mean over here is that it means that the US economy is still hovering on a growth phase. Okay, that means i.e. Two things that possibly over here is i.e. there is no signs of a growth deceleration, which also could mean that the US Federal Reserve is in no hurry to start cutting interest rates. All right, so that actually also explain to us that the US Federal Reserve is among the major central bankers to be the less dovish, okay, on top of RBA. Okay, so with that in mind, that actually pushes the dollar to a stronger pace of appreciation on last Friday. So if you look at the dollar index on last Friday, let me very quickly jump straight to the dollar index. Okay, where's the dollar index? This is the dollar index. Okay, so what we could see over here is that the dollar index managed to have to close a much on Friday. This was Thursday. On Friday, so two consecutive positive close after a rebound at the 50-day moving average. Right, so all in all, what we could see over here is that the momentum is rather positive on the US dollar index in general, being reinforced by that stronger than expected US services PMI that was released on Friday. So net overall, what we could see over here is that that particular strong reflection of a much more robust, or I would say that still resilient US economy could potentially kind of supports the current US Federal Reserve not in a rush of urgency to cut interest rate or kickstart an interest rate cut cycle that could actually lead to a firmer US dollar, at least in the short term, potentially with the next resistance to come in at 106.37 in the near term, which is correspond to the 17th of April and 1st of May swing high, and as well as this medium term descending trend line that I drew from the high of 4th of October as being reflected on the daily chart of the US dollar index as per se. And also, on the other hand, this dollar strength is also being driven by a potential political instability that could arise from the Eurozone. Why? Because of this upcoming first round of France, not presidential, is France localized parliamentary election. That means the voters will vote for the France parliament this coming it's actually two rounds. All right, the first round will be held on this coming Saturday 30th, and the second round will be on the 7th of July. So to confirm, you just could Google it over here, French election. All right, you're able to see the dates over here. All right, so it's first round 30th of June, followed by the 7th of July. And what we could see over here is that based on the latest poll, uh, which is done by some pollster in French, actually saying that the far right party is now leading by a wider margin in terms of poll. No, this is not the actual result. This is based on the poll. Is at 36%. So they widen their lead based on the last poll. And what we could see over here is that if you scroll down, okay, so Macron, that means the current president party, it's the one that has the slimmest margin at 20%. And also another poll published on Sunday shows Macron's approval rating tumble by 4 percentage points to 28%. So it seems to us that the voters are in favor of the far right party of gaining a foothold in the French parliamentary election. So what does it mean in terms of economic prospect in Eurozone? Bear in mind that the French is one of the key economic anchor country in the Eurozone and Euro Union. And with the policy advocated by the far right party tends to be much more anti European and in a way that they are more embracing what I call the traditional norms of the Eurozone, we call it a culture, i.e. they are more advocate towards expansionary fiscal spending and a bit of protectionism policy. And given the fact that if they start to push out for much more fiscal expansionary policy, and that could actually start to see an increase in taxes. All right, so that also doesn't gel well for the French economy in the longer term perspective. And the market has really responded by bidding up or selling off the French government bond against by looking at the spread between the French government bond and its counterpart, the Germany 10-year government bond. So if you look at this aspect over here, let me share with you all. Okay, so ever since the bullish breakout 2 Fridays ago, all right, it broke a base over here. This is the spread between the 10-year sovereign bond of France 10-year sovereign bond divided by the 10-year Germany sovereign bond. So this is the weekly chart. So what we could see on the daily chart on Friday, after that pullback that was seen on Monday, it starts to do a curvature tick up again. All right, so what it means that market participants is viewing an increased credit risk in holding French government sovereign bond. Okay, so that actually implies to us that ongoing political instability in the upcoming French legislative parliamentary election that could potentially lead to an increase in credit risk for France government bond. And as I explained earlier, France is a key anchor economy of the Eurozone and that could actually translate to a risk of sentiment, at least in a short-term perspective, that also drive up the dollar strength, and eventually we will potentially also see start very strangely. What I could explain over here is that we also could see a flight to safety. Okay, where is it over here? Oops, sorry. Yes. So on top of the dollar strength start to increase, we also see a flight to safety in the US Treasury bonds, the 10-year. So that actually causing the bonds to be bid up as well, pushing it down the US 10-year Treasury yield. So that could actually explain to us why there's this inverse relationship right now between the US Treasury yield and the US dollar index. All right, so previously, prior to this potential risk of event that may take shape in Eurozone, we start to see a direct correlation between the US 10-year Treasury yield and the US dollar index. That means previously we start to see a push up in the US 10-year Treasury yield. That will also see a push up in the US dollar index. But now the inverse relation holds true. Why? Because of a potential risk of event where market participant tends to actually park their funds in US Treasury bonds or notes that actually beat up the bond price and lead to a fall in the yield, and as well as lead to appreciation in the US dollar, as I just showed on the technical chart of the dollar index. So now with that, right, what we could see over here is that very interestingly, the 2-year Treasury yield also exhibit the same kind of behavior. Okay, where is my 2-year? I think it got jumbled up over here. Yes, this is the one. Okay, it also tends to remain soft below the 200-day moving average. All right, after breaking below this medium-term ascending channel that I drew from the low of 16th of January this year. Okay, so that is the current situation right now, based on from a FX market perspective. Then how about the situation in the US stock market on last Friday? So if you look at the US stock market performance on last Friday, it's rather a mixed bag performance. Why? Because last Friday we do have we call it, it's more of a product related event. We call it a triple witching event, where we start to see a quarterly option on single stocks on index, and as well as option on futures expire on the same date on last Friday. So what we could see over here is a rather mixed bag performance due to this triple witching option expiry on last Friday, where we see the Dow Jones Industrial Average and the Russell 2000 managed to inch up a slight gain. The Dow Jones 0.04%, the Russell 2000 0.23%, but however the Nasdaq and the S&P underperformed with negative 0.26% and negative 0.16%. So the rationale, what is taking shape on last Friday is the underperformance of the S&P and Nasdaq is due to the heavyweight semiconductor stock. So what we could see over here is that we know that NVIDIA right now has already taken on Tuesday itself is roughly become the world's most valuable company after giving back its gains on Thursday and Friday to drop down to the second spot, all right, behind Apple. So what we could see over here is that NVIDIA underperformed among the mega cap technology stocks over here at negative 3.22% because of its significant influence or weightage in the S&P 500 and the Nasdaq 100 that causes the S&P and the Nasdaq 100 to actually underperform on last Friday. So overall, if you look at the heat map of the S&P 500, it's rather healthy. I mean, it's not showing all the mega cap stocks is selling off. We do see some positiveness coming out from Google, a positive 1.44%. Amazon positive 1.6%, and Microsoft positive 0.92%. All right, so it's more like a outlier that is being caused by NVIDIA, but nevertheless, this outlier by NVIDIA could actually potentially see also further weakness if the NVIDIA technical elements is not so rosy after last Friday negative price action. So later we'll take more about that when we look at the short-term technical intraday outlook on the Nasdaq, where I will do a hand-in-hand comparison with Nvidia. Why? Because Nvidia right now has a significant weightage in the Nasdaq that could influence the movement of Nasdaq, at least from a short-term perspective. All right. So with that, one more news that event I want to take up for over here is on last Friday. We look at the price of the FX market over here. Where was it? Give me a minute. Let me. Yeah, so this is the 5-day rolling performance of the US dollar against the major currency as of right now we are speaking. So on last Friday, right, we see a very, very strong push up on the dollar against the Japanese yen. So the Japanese yen continue be the weakest major currency against the dollar. And last Friday, it actually went up and retest very closely the 160 level that actually led to the prior intervention by this Bank of Japan under the instruction of the Ministry of Finance. And do not forget over here is that also that on last Friday we also do have a slew of very lackluster Japan data, where the Japanese services PMI, which I actually highlighted earlier, went down below expectation. So very quickly, maybe let me flash out the services PMI data again for those who missed my Friday daily dose of market insight. So what we could see over here is that Japan services PMI data, flash one for Friday for June, actually contracted to 49.8, way below 53.8 that was printed in May. And also the core inflation rate in Japan, which is excluding fresh food and energy, continues to decelerate 2.1% year on year, inching down lower from 2.4% year on year that was printed in April. So with these two lackluster data that is coming out from Japan, market expectations starts to actually be much lesser or less optimistic for BOJ to actually hasten their pace of policy normalization. That means, i.e., the next interest rate hike from BOJ coming in July. Initially, there was high hopes about it, but after the release of these two lackluster Japanese key economic data, that possibility has started to reduce as well. So that is being translated into a rather strong dollar yen on last Friday, looking to retest that 160 figure level during the US session. And also on top of that, that also being reinforced by that stronger US preliminary services PMI data, which I highlighted earlier. So this morning, due to this fast and furious move up by the dollar yen on last Friday US session, prompted this Bank of Japan vice minister that is in charge of international affairs. That means, i.e., he's actually in charge of deciding whether MOF wants to intervene in the FX market. Okay, Kanda. So by Mr. Kada this morning actually state this very startling statement saying that Japan is ready to intervene in the currency market 24 hours a day if needed. All right, so I believe that this is a rather strong verbal kind of intervention to the market, saying that the authorities are watching for signs of any erupt movement on the dollar yen rate. So later I'll touch more on the dollar yen intraday technical outlooks for the key levels to watch out for. All right, so with that, that actually sums up today's kind of a gel of not short term news event together with the fundamental and intermarket dynamics, okay, in one shot. All right, so now with that, let us now quickly jump straight into the short-term intraday technical outlook, starting from the FX market first over here. So starting with the FX market, let us very quickly go to the euro dollar. All right, so before I go to the euro dollar, let me expand my screen so that you guys could see much clearer. So euro dollar, so like I explained earlier on that the dollar strength starts to actually come back on last Friday due to this potential risk of event that is coming out or from that potential not so desirable French local parliamentary election that is coming out on this Sunday, for it is this Saturday for the first round, pardon me. So what we could see over here is that the euro dollar broke below the short-term pivotal support level that we highlighted on last Friday at 1.07 level. So right now it's actually getting rather lackluster in terms of the short-term intraday technical outlook. So what we could see over here is that a breakdown below last Friday 1.07 starts to print a series of lower high being kept by this descending trend line in place since 7th of June. Okay, this minor descending trend line in place since 7th June. And the minor descending trend line right now is at a resistance close to the minor swing high of 20th of June, where price action refused to actually shape higher since last Wednesday, which is at 1.0750. So with that, I'll be using 1.0750 as my short-term pivotal resistance for today. Flip to a short-term intraday bearish bias on the euro dollar. First support level to watch will be at 1.0656. So what's 1.0656? It's rather a key medium-term support level. Okay, so this 1.0656 actually confluence with this ascending trend line support that I drew from the low of 3rd of October 2023, which i.e. also could correspond to the lower limit of this medium-term symmetrical triangle that the euro dollar has been evolving since its high of 18th of July last year. All right, so right now if you start to see a breach below this 1.0656 level, potentially the euro dollar could actually expose the next near-term support coming in at 1.062, 1.06 figure level, which correspond to the swing low area of 17th of April and 18th of April. Only an hourly close above 1.0750 will invalidate or negate today's short-term intraday bearish bias to see a push up or recovery to retest the 50-day and the 200-day moving average at I think as a resistance zone as well at 1.077 / 1.0790. Above it, may see the next near-term resistance coming in at 1.0815, which correspond to the minor swing high area of 13th of June. And if I do the Fibo retracement of this last push down from 4th of July all the way down to the low of 14th of July, that means close to about a 1 month, 4 week of decline, it corresponds to the golden ratio very closely at 0.618 as well. Right, so moving on, let us now flip to the sterling dollar, or the cable we call it. So the cable also also kind of pretty much bearish, but still managed to hold above the 50-day moving average. But price action seems to be shaping lower highs as well, getting a bit lethargic, I would say. So what we could see over here is that if I were to start to draw a kind of a descending channel, taking from the high of 12th of June, the upper limit of that channel actually correspond to the first resistance right now coming in at 1.2660 level. All right, so but I don't put it so tight, I put it roughly slightly higher at 1.2690. So what is 1.2690? If I were to actually also do the Fibo retracement of that last swing down over here, okay, from the high of 19th of July all the way to last Friday low, it corresponds to the golden ratio as well. So with that, I'll be using 1.2690 as my short-term pivotal resistance to flip to a short-term bearish bias on the sterling dollar. First support to watch will be at 1.2610, which is close to the 50-day moving average, which is this former minor swing high of area of 3rd of May, now turns to the pullback support. A breakdown below it exposes the next support level at 1.2565. We also confluence with the 200-day moving average acting as a support as well. Only an hourly close above 1.2690 will invalidate today's short-term intraday bearish bias on the sterling dollar to see a round of minor recovery to retest the 20-day moving average acting as a resistance now at 1.2740. Above it exposes 1.28 figure level, next near-term resistance level to watch on the sterling dollar. All right, so now going forward will be the dollar major against the Asia Pacific currency. Okay, starting with the Aussie dollar first. So on the Aussie dollar, what you could see over here is that it broke down below the 20-day moving average, which was also our short-term pivotal support that we have on last Friday. So given the clear breakdown of this 20-day moving average, very likely is now potentially floating down back towards the lower half of that medium-term symmetrical range triangle configuration that is still in play. So with that, I don't want to put it so tight at 66.40, 66.50 level as my so-called first short-term pivotal support level for today. Instead, I'll use this very clear minor swing high area from last Wednesday and Thursday that was rejected at 66.75. So as long as 66.75 short-term pivotal resistance holds, we'll flip to a short-term bearish bias on the Aussie dollar. Next near-term support level to watch will be at 66.10. A break below it exposes 65.90/65.80, which is corresponding to the 50-day moving average acting as a support, and as well as the minor swing low area of 17th of June and 10th of June. Only an hourly close above 66.75 will invalidate today's short-term intraday bearish bias to see a push up towards the upper limit of that symmetrical triangle range configuration at 6710/6730. So this is the symmetrical triangle range configuration that I'm talking about in a medium-term perspective. So if you look at from the daily chart of the Aussie dollar, since the low of 13th of October and the high of 3rd of February last year, it has been evolving in this medium-term symmetrical triangle, and price action has started to shape a series of very close rejection near the high of that symmetrical triangle range resistance at 67.30. All right, in the past 2 weeks or so, or 1.5 weeks or so, pardon me. So that's for the Aussie dollar. Now, going forward, let's take a look at the dollar yen. So this is the dollar yen, what I'm talking about. So the dollar yen right now on last Friday is approaching the April 1999 swing high area. So that's close to a 34-year high, and as well as the 160.30 level swing high that prompted the BOJ under the instruction of MOF, the Ministry of Finance, to intervene in the FX market, allegedly to buy yen and sell the dollar. So right now it's approaching this level again, and also coupled with that very firm verbal warning from the Vice Minister Kada, that's in charge of the international affairs. That means, i.e., he's the boss who actually decide whether the Ministry of Finance should actually intervene in the FX market. So if you were to look at the RSI right now, let me open an RSI for you all to see. Okay. Oops, where is it going? Okay, over here. So if you look at the RSI right now over here, is that there's no signs of exhaustion as well. I mean, it's not really extremely overbought as previously seen in the last round of that intervention over here. So given this particular RSI that is still showing signs of bullish momentum, going forward, at least from a multi-week perspective, this uptrend here seems to be still intact, and potentially it could start to see the next resistance coming in at 161.10, 162.40, but that's more for a multi-week perspective because this is a daily time frame chart. But how about from a short-term perspective? So on a short-term perspective, given the fact that after that kind of a rather firm intervention up from today, verbal intervention, I would say, not real intervention, the dollar yen could actually trade in a sideways range on an intraday movement for today. And also given the fact that the hourly RSI, after shaping that bearish divergence as seen on today's Asia session, right, there's a bearish divergence, price action shape higher high, bearish divergence, and the bearish divergence also start to exit up from the overbought region. So that actually explain potentially a bit of initial or consolidation that could actually take shape right now, but I don't want to turn outright bearish. Why? Because the daily time frame chart on the dollar yen that I flashed to you all, it's still exhibiting no signs of a bullish exhaustion. So with that, I will actually flip to a neutrality stance for today, given that the mixed elements, I would say conflicting elements from the daily time frame and the hourly time frame in terms of their respective RSI reading or the RSI observation. So for the short-term intraday today, I will flip to a neutrality stance for the dollar yen between 160.30/40 and 159.10. So only an hourly close below 159.10 may start to see a intraday pullback scenario to occur to expose the next near-term support area at 158.30/158 figure, which is the former minor swing high area of 18th of June and 14th of June, and as well as 1st of May, that now turns into a significant pullback support level. If this support level doesn't hold, the next level to watch out for will be the key 20-day moving average that is acting as a support at 156.90 as well. We also correspond to this ascending channel minor support from 5th of June and as well as the minor swing low of 14th of Jan. All right, so that sum up for the intraday technical outlook on the FX market. So with that, let us now focus on the major stock indices, starting from the Asia Pacific indices first, with the Hong Kong 33 or the Hang Seng Index. So still recall on the Hang Seng Index, last Friday we flipped to a bearish bias after the failure on last Friday to recapture above the 20-day moving average, and it starts to print down much lower. So today it's going to inch lower and hit the first support level that we highlighted on last Friday, 17,780. So with that, the price action still continue to remain weak. Yes, the RSI has already starts to hit the oversold region level, but there is no bullish divergence as this low continues to be lower low. All right, there's no bullish divergence, so indicating that the bearish momentum it's still haven't shown signs of exhaustion yet. So with that oversold region, potentially it could shape a bit of a pullback or a snapback intraday rally. But with that, I will still have a short-term bearish bias for the intraday basis. So as long as that pushback or that a snapback didn't surpass 1817 short-term pivotal support resistance level, pardon me, not support level, we also correspond to the 50-day moving average, now also acting as a resistance as well. And if we do the Fibo retracement of the entire push down from last Thursday all the way to today's low, it corresponds to the 38.2% Fibo retracement. So as long as that particular snapback didn't surpass 18,070, we will still maintain that short-term intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. Below 17,780 exposes the next near-term support at 17,600, which is the minor swing low area of 2nd of May, and below it sees the key 200-day moving average coming to as a support at 17,170, which also confluence with this key medium-term former minor swing high of 13th of March and 9th of April now turns into a pullback support. Only an hourly close back above 18,070 will negate today's intraday bearish bias to see a much more we call it steeper bounce to retest the 20-day moving average, acting as a resistance at 18,300 level, and above it potentially sees a retest on last Thursday minor swing high area. Okay, give me a minute, it's hang. Gosh. Okay, 1 second, I think it's hang because I'm trying to anchor it to this level here. Okay, give me a minute. Okay, at 18,450. All right, so that's for the Hong Kong 33. Now moving on, next will be the next Asia Pacific indices, will be the Japan 225 or the Nikkei 225. So no change. The Nikkei 225 managed to float up towards the first resistance level that we highlighted on last Friday. Still during last Friday, we still have that bullish bias. So right now it's testing the resistance level again. So very likely it may just start to trade sideways. So with that, I rather have a neutrality stance right now. So neutral between this. Okay, maybe I'll just adjust it slightly higher. Okay, 38,830. Okay, so neutral between 38,830 and 38,240 level. Okay, so neutral between these two range. Unless we have an hourly close above 38,830, then potentially we could see a revisit up to this medium term range resistance upper limit, close to upper limit over here. Because over here, if you look at the Japan 225, since the low of 19th of April, is still trading in this kind of very complex sideways range configuration. All right, so after 38,830 may expose the upper limit of this complex sideways range configuration, with the next near-term resistance at coming in at 39,020, followed by 39,290 next. All right, so that's for the Japan 225. So now moving on will be the Europe stock indices, that means i.e. the German 30 or the German DAX. So no change, the German DAX continues to have that bearish reaction of the short-term pivotal resistance that we highlighted for last week at 18,000, or last Thursday and Friday at 18,240. So with that, still using the 18,240 as my short-term pivotal resistance level, still maintain that short-term bearish bias. First support level to watch will be at 18,070. A breakdown below it exposes the last two Fridays swing low area at 17,990/17,930. Only an hourly close above 18,240 will invalidate today's short-term intraday bearish bias to see the continuation of this counter trend rebound or mean reversion rebound to give a test at the 50-day moving average, acting as a resistance at 18,380. Above it, potentially sees the next near-term resistance coming in at 18,520. Right, so that's for the German DAX or the German 30. Now moving on will be the major US stock indices, starting with the US Wall Street 30 index. So the US Wall Street 30, yes, on last Friday, it tried to inch up higher, almost hit the first resistance level at 39,390 before trading sideways, all right, on last Friday. But if you look at the momentum condition on the hourly basis, that means i.e. the short-term momentum condition is not so rosy. Why? Because price action shapes similar high over here, but the RSI has started to shape a very clear, obvious lower high. There's a bearish divergence. And also by the close of last Friday US session, it also did a bearish breakdown below a key parallel ascending trend line support that I drew over here. So what it means that over here is that the condition on the hourly basis on the RSI indicate to us that the short-term momentum condition has turned bearish or turned negative instead of positive, all right, given the observation of the bearish divergence and as well as the breakdown below a key parallel ascending trendline support on the hourly RSI. So with these two bearish element that is being flashed out on the hourly RSI, I will be not so confident to actually stick to a short-term intraday bullish bias stance on the US Wall Street 30. So potentially there could be a mean reversion decline taking place on the US Wall Street 30, given the negative element that I explained or highlighted on the hourly RSI earlier. So using 39,390 as my short-term pivotal resistance level for today, flip to a short-term intraday bearish bias for a potential minor mean reversion decline that may play out on the US Wall Street 30, with the first support level to watch at 38,940. A break below it sees 38,730, that confluence with the 50-day and the 20-day and the 50-day moving average acting as a similar graphical support level at 38,730 as well. All right, and if we were to have an hourly close above 39,390, then it will invalidate this today's intraday bearish bias on the US Wall Street 30 to see the continuation of that recovery or rebound for the next near-term resistance to come in at 39,600, followed by 39,790, which is the minor congestion area of 21st of May and 22nd of May. All right, so now Nasdaq 100. So before we touch on Nasdaq 100, let's have a quick look at NVIDIA first. Why? Because NVIDIA is an important component stock inside the Nasdaq 100. So if you look at the daily chart of NVIDIA over here, so what we could see over here is that the price action actually gapped down on last Friday due to that also potential triple witching as well, due to the fact that NVIDIA is being a very highly popular traded option, and as well as that the triple witching see this option expiry on Friday, so there could be some kind of flows related price action movement on last Friday that causes the gap down. But what's interesting, this gap down it actually lead the daily RSI to exit from the overbought region. All right, and on top of that, if you look at the price action on the weekly time frame over here, it starts to also shape a bearish harami candlestick price action. Okay, taking into account of these two candlestick, the big white candlestick, the larger white candlestick, and the doji like candlestick that was formed at the end of last week. All right, so with this bearish candlestick pattern, and as well as the exit from the daily RSI from its overbought region, the price action of NVIDIA could be now shaping signs of a retracement, all right, to retrace the very steep up move from 19th of April. So the next support level to watch in this retracement, I mean, the major trend is the medium term trend is not damaged yet. Why? Because the price action is still holding above the 50-day moving average, and as well as the key medium-term pivotal support at 95.50. So the next support level to watch, at least in the short term, could be the 20-day moving average at 118.32, followed by the 50-day moving average, which is this gap support over here, the upper limit of the gap support, slightly above the pivotal support level, which is the lower limit of the gap at 105.50. All right, so if we do the Fibo retracement of this steep up move up from 19th of April all the way up to last Friday's this, I would say this 19th of April all the way this 2 months push up, it's at the 38%, 50% Fibo retracement and 61% Fibo retracement for the medium term and the 50-day moving average, and close to the 23% Fibo retracement on the 20-day moving average, I think as a support. So we know that at least in the short term, there could be some weakness coming into NVIDIA based on the technical element that I share with you all. And given that NVIDIA has a significant weightage inside the S&P and the NASDAQ 100, that could also translate to potential intraday weakness or short-term weakness on the NASDAQ 100. So this gives rise for us back to the short-term technical outlook on the NASDAQ 100. So given the fact that the NASDAQ 100, even though it's still holding above the 19,700 short-term pivotal support that we highlighted on last Friday and Thursday, but given the fact that the technical elements of NVIDIA, which has a significant influence on the NASDAQ 100, doesn't looks quite rosy, which I highlighted earlier. With that, I will actually not so convinced, or I would say that confident to actually remains a bullish intraday bias for the NASDAQ 100. So with that, I'll flip to a short-term intraday bearish bias on the US NASDAQ 100 for a potential mean reversion decline to take hold. So neutral between not neutral, bearish bias between below 19,990 short-term pivotal support resistance level, not support level. So the first resistance level to watch will be on last Friday high, which is this level here, but I don't put it so tight as much. Pivotal resistance level, I will use 19,990. So what's 19,990? If you look at the swing move down, or the dip down from the slide down from 20th of June all the way down to last Friday's low, is close to the golden ratio at 61.8% Fibo retracement as well. So as long as any today's any potential bounce didn't surpass 19,990, I will flip to a short-term intraday bearish bias. A breakdown below 19,700 level will expose the next near-term support level at 19,480. Below it sees the 200-day, the 20-day moving average also coming to as a support at 19,240. Only an hourly close above 19,990 will invalidate today's short-term intraday bearish bias for the potential mean reversion decline scenario to unfold, to see the continuation of that impulsive up move. Next resistance to watch 20,120/155, followed by 20,260 level on the NASDAQ 100. All right, so that sums up for the major US stock indices outlook. So if I could have a quick recap over here, is that all of them seems to be shaping near-term or short-term weakness at this juncture, with the exception of the Japan 225 kind of mixed elements. So we flip to a neutrality stance on the Japan, i.e. the Nikkei 225. So with that, let us move to the commodities market, starting with gold, the XAU slash USD. So still recall gold last Friday we flipped to a bearish bias because it's approaching the resistance at 2,386. So price action indeed came down and hit the support level, which is at the 20-day moving average. At the point in time, it was acting as support at 2,330, then 2,320 level. This zone here, it will hit this support zone. What we could see over here is that the price action of it seems to be rather lackluster again as well. And where the price actually rejected on last Friday, it rejected right exactly at this minor descending channel now in play because of the last Friday rejection, in place since the high of the all-time high of 20th of May. So overall, net what you could see over here is that last Friday's price action indicate to us that there could be still some form of weakness going into gold to continue to shape this medium-term corrective decline scenario starting from 20th of May within its major uptrend phase. All right. So with that, for today, I'll be using the 2,345 as my Titan short-term pivotal resistance level. If we take into account of last Friday push down from the high to the low, it also corresponds to the golden ratio closely at 61.8%. So as long as 2,345 short-term Titan short-term pivotal resistance is not surpassed the upside, which will correspond to the 50% moving average acting as resistance as well. Potentially XAU slash USD may see another round of potential weakness. Near-term support level to watch will be at 2,308, which is the minor ascending trend line that I drew from this 7th of June. Okay, a breakdown below it exposes the next resistance zone, next support zone, pardon me, not resistance, next support zone at 2,280 slash 2,270, which is the minor swing low of 3rd of May, 1st of May, and as well as the swing low of 4th of April and 5th of April. Right, only an hourly close above 2,340 may see another round of rebound to retest the descending channel resistance at 2,365 level. Above 2,365 sees the extension of the rebound to retest the 7th of Jan minor swing high area at 2,386. All right, so that's for spot gold XAU slash USD. Now, lastly will be the West Texas crude oil. So West Texas crude oil, WTI crude oil continues to be lackluster. So if you look at the daily chart of West Texas crude oil, on the daily basis, the price action continues to be rejected at around the 81 level mark over here. So there seems to be some form of resistance at this level here. Oops. Okay, this former minor swing high turns into a pullback resistance level. So on a hourly basis over here, still recall we do have that resistance at 81.90. So this 81.90 was kind of tested on last Friday before shipping down and hit the first support level at 80.70 level. All right, 80.70 level. So with that, with the RSI also breaking below that parallel ascending trend line support level on last Friday, we will still maintain that short-term intraday bearish bias on the West Texas oil. Okay, a bit of excess over here on last Friday, 81.90 slash 82.20 level, because the high was 82.20. All right, so give a bit of excess here, 82.20. Yeah, will access 82.20. So 81.90, 82.20 short-term pivotal resistance level. right now, a breakdown below 80.70 exposes the next near-term support area at 79.45/78.90, which is also correspond to the minor swing high 4 months 12th of June and 14th of June now turns into a pullback support zone, and as well as the key 50-day and the 200-day moving average also coming close to as support. This support zone area at 79.45/78.90. Only an hourly close above this 82.20 excess short-term pivotal resistance level will see the continuation of the recovery towards the next near-term resistance at 82.90, followed by 84.40 level. All right, so this congestion area here from 26th of April, 29th of April. So that's sum up West Texas Oil and also the short-term intraday technical outlook on the major cross assets. Okay, so before we go for today, let's have a quick look at the economic calendar of what are the data to look out for today. So today's data during the European session, there will be a Federal Reserve official speaking, Fed Wheeler, at 3 p.m. Singapore time. And 4 p.m. We do have one Germany, we call it a business sentiment data. They call it the business climate and the current condition out for the month of June at 4 p.m. Singapore time. Then thereafter, we do have a rather quiet US session. Only at 2 a.m. Singapore time, we do have another Fed official speaking, Fed Dallas speech at 2 a.m. Singapore time. And early tomorrow Asia session, before the start of our daily dose, at 8:30 a.m. Singapore time, we have Westpac consumer confidence data. That's the Australia consumer confidence data out at 8:30 a.m. Singapore time. So with that, that pretty much sums up today's daily dose of market insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.